Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now, boy, did we luck out. He was previously scheduled, but thank God he's here. Thierry Wizman is with Macquarie, and I just can't say enough about his perspective here on economics with parchment off the Charles River in Boston and decades of following this. I demand, Terry, that we have some historical perspective. Everybody's in an uproar. Bill Pulte here in 20 minutes, and that I want to get to that with you in a bit. Alexis says, Alexis, you're not Scarlet Fu. You have 42 questions ready. We're not going to have time for them. 1951, Thomas McCabe tells Harry Truman to go to hell. That's where this started. And they dragged off Korea War and sky-high 1947 inflation, frankly, into a 52 deflation, the independence of the Fed. Why is that so sacrosanct? What is it about 1951-ish William McChesney Martin independence that's important?
Well, I think the broader question here is why is independence important, not why is independence important at a particular point in time. We're talking about structural independence of the Fed, not independence based on a time and place. And I think independence of the Fed is important because we believe, or at least, and certainly academics have shown through their research, implicitly that the White House and the executive branch have a different reaction function than the Federal Reserve. In other words, the White House tends to put more emphasis on what the electorate wants to see in the short term, especially in key election years, let's say. And the premise here is that the White House's reaction function, if it's driven by what the electorate want, is going to put more weight on driving growth, on reducing unemployment, and on keeping mortgage yields low, more so than it would worry about inflation. The Fed, on the other hand, has a dual mandate, which is much more balanced, which is much more symmetric. In fact, that's encoded in the law, that it should pertain to looking at unemployment and inflation without a bias, the way that the White House might have. That's the key behind the need to preserve independence, because if you believe that inflation should be a weighty matter for policymakers, then let's keep the White House away from policy.
And Alexis, dragging it from 1951 to 2026, so much of this is still about coming off the pandemic. And where are we coming off of COVID?
Yeah, I mean, I think that's a great question. And now, of course, we're looking at a new year with a new Fed chairman going to take over, whoever that might be, come May 15th. I'm wondering if Powell will be inclined to want to stay on it in any capacity after what's happened now, because he's able to legally stay on.
That's correct.
Not as chairman, but as a board member.
That's absolutely right.
Do you think it may behoove him to do so?
I think it might. I think that would simply open him up a little bit more to legal recriminations from the White House. So that's a decision that he's going to have to take, whether he wants to take that risk. I would say that simply going on the public record over the weekend with the comments he made displays a huge amount of courageousness, because effectively what he's doing is tempting this White House, and that takes some temerity, that takes some courage. So let's hand it to him. He's not backing down right now, to the extent that you should respect someone who has that kind of courageousness. This is a good thing.
Yeah. What about what this all means for the bond market, for the dollar? I mean, we are seeing some reaction. I argue not as much as I would have imagined when I saw this news come over my Bloomberg over the weekend.
Well, one reason we're not seeing that much of a reaction is because this is just the latest step in an arc of events. We kind of knew already that President Trump wanted to get rid of Jay Powell. We kind of knew that he wanted to exert his influence on the Federal Reserve structurally. So this is just another tool that's come out of the tool chest, but it's not a different approach, effectively, or a different goal. I think in that respect, the market was already starting to acclimate to the prospect. Remember also, this doesn't necessarily change who's going to be the Federal Reserve chairman going forward, right? We kind of knew, as you mentioned, that Jay Powell was on the way out. So in that respect, things haven't changed. But at least the direction of the market makes sense, right? For bond yields at the back end of the curve to move higher makes a lot of sense if you in a world that's going to be structurally more inflationary.
Good morning across the nation. On YouTube, subscribe to Bloomberg Podcast. Can't say enough about that experiment. Really humbled by the continued growth we see on YouTube. To give you the field of play here, in about 20 minutes, John Farrow in conversation with Bill Pulte. This is the grandson of the Pulte Housing founder. He's chairman of the Federal Housing Finance Committee. He'll be front and center. We're going to talk more about that interview with Michael McKee and Thierry Wizman with us here in a bit. Kelsey Barrow on the bond market coming up as well with JP Morgan. Dr. Wizman, what kind of economy right now does President Trump enjoy? Over the weekend, I was flabbergasted by the 12-month 2025 sum of a dearth of job formation. I mean, is this basically, and foreign events as well, a distraction from a really ugly economy?
I don't think the premise of your question, I think, Tom, is a bit off. I don't think this is an objectively poor economy. There are certain things in the economy that are actually going quite well, and I would point to productivity growth as one of those things that's going fantastically well, as judged by the numbers that have come out. And growth itself, on the back of that, has been strong, despite the fact that we are not seeing much job growth. On the matter of job growth itself, there are a few reasons why we can ascertain that this is not about a demand deficiency. This slowdown in hiring is not about a demand deficiency. It could be simply because some new entrants into the labor force, college students, are simply not being hired enough. It could be the result of some policy uncertainty, but it doesn't seem to be as grave as to warrant a worry about a recession coming up.
What about the biggest headwind that you see for this economy in this new year?
Well, it's the same headwind that I perceived last year, and I think it's still a valid headwind, but whether it's going to be enough to offset the good things is hard to say at this point. We suspect it won't be. But that issue, that pessimism, if there should be any, derives from what's happening with the low-income consumer, the low-income household. Is he sufficiently burdened, or he or she sufficiently burdened by debt and by a real wage that has not been growing, to really start to suppress the amount of spending that household does? We suspect that they could, but not enough to offset, again, the other components of spending that we expect to be strong.
Again, that K-shaped economy.
If you want to put it that way, I don't particularly like that expression. But it's important to keep in mind that the high-income household has been responsible for an ever-growing share of consumption in the economy. And the economy, as a result, depends more on what the high-income household is doing.
At 14 minutes after the hour, at 44 minutes after the hour, we note to our audience worldwide that I have the plague.
No, which is why we're in this small room together.
It's hermetically sealed. Thierry's on the other side of the cone of silence here. I got what everybody else has, folks. Good luck with it. Get a flu shot. Talk to your doctors, and don't have a fever, and don't show up for work if you think you're contagious.
It's tough out there.
And now
there's a nurses' strike on top of it all here in New York City.
This is the first big challenge for the mayor.
Yeah.
Let's vamp on that to Thierry Wizman. We can do that. Thierry, let's do an audible. McKee's going to sit down wearing his Denver Broncos tie today. Dr. Wizman, just as simple as I can, the wage angst that's out there is tangible. Is a nurses' strike something to look forward to for all of this year? Labor unrest?
Look, I would suggest or submit that it's more important than, say, the workers at Starbucks going on strike. I think this is a question of degree. Nurses and what they do are critical, not just to patients, but to the economy overall. And I think, Tom, you just mentioned exactly why. If people get sick, they don't show up to work. If people don't show up to work, nothing gets done. So that's why a nurses' strike is pertinent. Now, of course, this is a localized one. It only is going to happen in New York City. But more generally speaking, you don't want to see healthcare workers unable to do their job. We know what happened during COVID. It was a disaster in that respect.
Yeah, well, thank you. This is what we do, folks. This is the way we roll together. Michael McKee driving all of our economics, and Thierry Wizman of Macquarie with us today. Mike, Glenn Thrush and Colby Smith in the New York Times say there's a legal thing with Mr. Pulte here of pushing these things, and then the courts just push it aside. Do you anticipate with your reading this morning that the courts will push aside this criminal threat to the chairman?
I am not going to hazard a guess on that, but we can point to the track record of the administration, and that is trying to indict James Comey, trying to indict Letitia James, and failing in both cases multiple times. So I don't know if they will go ahead with this. If you are to believe the president, he didn't know anything about it, which is what he said last night. then you could imagine him telling Jeanine Pirro to back off and drop this investigation, because it's not going to go well for the administration here, and it isn't. It makes no sense. I don't see what the end game, what the president gets out of this.
The number one interview for Bloomberg last year was John Farrow with Scott Bessent. It was viral in the zeitgeist for 3 weeks. This morning, I have Bessent's silence. Are people like Bessent and even Secretary Lutnick saying to the president, you got to be kidding me, yield up, price down? Mike, is that what's going to happen?
Well, we are hearing that a number of administration officials, and I don't know if Scott Bessent is among them, were caught off sides by this, did not know that this was happening. And it certainly could be a case of Pirro going rogue on her own, a little bit of the old, will no one rid me of this meddlesome priest kind of thing, taking the president's anger at Powell and running with it. But you're right, it doesn't do him any good, because at this point the markets are reacting negatively. Now there's so many other things that can go wrong in the next hour, let alone the next week. But it is not something that is going to play out well for them, particularly with Tom Tillis saying he won't vote for anybody because he's a Republican on the banking committee, split 13-11 between Republicans and Democrats. You lose one Republican and you can't get a nomination through for chair. So this isn't, it probably isn't playing out the way you would have drawn it up if you were trying to do a conspiracy theory.
So is this really, in essence, a criminal investigation about how taxpayer money is being spent? Is that what the DOJ is looking into here?
Well, what we've been told is, yes, it's a criminal investigation. It is into whether Powell lied to Congress about these renovations. It is not a lawsuit that Trump was threatening. Nobody knows how he would do it for malfeasance or for not managing the project well. But Powell's going to be out of office as chair in 4 months, and this might just stiffen his spine and lead him to stay on as governor, which he can do until 2028. Do
we need more dissent, Dr. Wizman? I mean, I know you studied. I'm so sorry, I can't remember who you took your PhD with at Harvard. But if it's Benjamin Friedman or Kenneth Rogoff, the late Marty Feldstein, I mean, there was a collegiality to this. Do we need more dissent at the Fed?
I think we do, but I don't want to express it in terms of dissent. A range of opinions is always healthy. I think that's the way I would put it. Having opinions from other business leaders from other regions. I mean, the reason the Federal Reserve was structured as it was, with this emphasis on a broad regional basis for decision making, it speaks to the need to have a diverse view of opinions. So I think that's good. Dissent in and of itself, to the extent that it's taking the economy in the wrong direction, of course, is not good. But a multiple of views is a good thing.
Thierry, thank you so much for joining us this morning. Really, really appreciate it. Dr. Wizman is with Macquarie driving all of their coverage. We greatly appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is a really important interview. It's way too short. Alicia Levine brings shockingly prodigious math skills to the art of buy, hold, sell, and what do you do with cash. Head of investment strategy at BNY Wealth. Is the math out of kilter right now? I think the headline story for me is the math is almost what I call normative. It's almost the dynamics, the pumping, the Newtonian churning of the market is actually normal and healthy. Earnings up, everything up, even if it's a little bit every day.
Yes. So my wrapping of 2025 was the noise is noisy.
Yeah.
And stick to what moves markets really in the long term, not on a daily basis, not when you come in the futures market. The noise is noisy for 2026. I think the noise continues to be noisy, and maybe we push the envelope. But ultimately, a lot of this is going to be seen as noise.
Right.
There is some risk of long-term degradation here as you get something of a bull market in populism. for both parties, that the policies themselves that have sort of brought us here may not be here, but I don't see that. Like, I still see a very strong year. I see 14% earnings. What I see in markets this morning, which is fascinating, is, we thought that tech would not be the leader this year. It would be the more cyclical sectors. And you're actually seeing it this morning. What's getting hit the most? It's NASDAQ. And it's not the S&P, it's not the Dow.
I get into the math, and Kudlow and MO, or Larry McDonald's great comments on the wall of money out there. BNY Mellon is expert at this. The overwhelming keel to this market is billions of dollars. It's got to find a warm spot to go.
It has to find a warm spot. And by the way, it's been coming to the U.S. And so all this talk about sell America back in April turned out not to be true.
And so when we're going to continue to see the shift, you say, out of the Mag 7, broaden out this rally. That would be nice, wouldn't it, in 2026? Where do you see the leadership coming from, though?
So the leadership, I think, here, even with the financial selling off this morning because of some of the policy proposals that we've seen and, of course, the news this morning about the Fed, I still think it's financials because we still see a steeper yield curve. And we also think it's industrials. And we also like down cap as well, particularly in the financial sector because...
What did you call it?
Industrials. Down cap.
Down cap.
Down cap. So in other words, mid and small cap companies. Okay. So down cap from your $4 trillion company, you've got a lot of industrials and
Did you just coin that? I've never heard of down cap.
Did I make it up?
She's gifted,
We're going to go with it, though.
Okay, down cap, right? Okay. So we're not talking about the Mag 7 anymore, but we're talking about... If we're in an M&A world, if we are in a deregulatory world, which is, by the way, pushing the multiples on the financials as well and price to book, then where are you going shopping? You're going shopping in mid cap. So you're not having two giant companies merge, but you're having more M&A in the mid cap section. So we like that as well. It's just a more interesting market than we've had, right? And in the end, if you think about what happened last year, the Mag 7, which I don't know if we should even call it that anymore, only 2 outperformed the S&P, and the S&P was still up. Total return, the S&P was up about 18%, including income. So that's a pretty decent, fabulous year. And so we can live in a world where companies are earning better than they did 2 or 3 years ago. Rates are coming down. We're getting deregulation in the energy and financials and industrial sector. What don't I love?
Okay, so the bombshell this weekend's Feroli over at JP Morgan says maybe we won't see any rate cuts. Other people, 2-3 rate cuts. Mr. Myron at the Fed is looking for 6 rate cuts. Do you just assume money market yields are coming down?
Yes.
And then the question is for BNY, for the people who enjoyed 5.5 and now they're joining 3.x, what do they do with that capital?
Look, we've been saying this for 2 years here, right? That you have to think about the reinvestment risk in the T-bills and on the cash side. And like we've been telling clients to move out in duration into the belly of the curve because that's where we see the most value here, and you'll get the benefit of the Fed cutting as well. So that's what we've been telling clients to do with the cash.
So you talked about down cap, mid caps. Small caps had a really nice year, didn't they? Right? Russell 2000, I think last check was up about 13% from last year.
It closed in with the S&P by the end of the year. Exactly.
So is the S&P going to have a little competition in the way of small caps this year?
So I think it could. Like we just see a much broader market. You're going to, the talk about concentration is also about what starts outperforming. And I think if you just have a pause, right, in the multiple expansion in the top 10 stocks, let's say, and the capital goes elsewhere, you have a world where international does well, emerging markets does well, small and mid do well as well. And you can still make a lot of money, but we have fully allocated portfolios. Like in the end, we fully allocate. And so this is a world where all those allocations can do well.
If we lost perspective, I look at the WEI screen at EM, the Damien Sassar world, like up 50%, up 30%, or that. Can we remind everyone that we're trying to make nominal GDP plus 200 beeps and like 8% per year, 9% tops is your normal equity return?
Well,
I would suggest.
But it hasn't been.
No, but we've lost perspective on the theory.
We've totally lost perspective. The average annualized return in the S&P since 2010 has been 12.5%. Okay. That is so far beyond what asset allocators are looking at for their capital markets assumptions. It's just,
okay.
And so the question is, are we going back to a world where rates are higher, where real yields are higher, right? Can you still assume you're going to get that 12.5% average annualized return?
Do you buy the Goldman? You're going to love this. Do you buy the Goldman Sachs linear extrapolation off a y-intercept that gets you way out to a single-digit return for S&P 500, like low single-digit return, because we've done so well recently?
No.
Why?
No, because I just think we're in a different market. We're in a market where we've got a 14% operating margin for the 500 stocks on average for the S&P versus the 9% 20 years ago. Are you just in a different?
See how she changes? You should have seen her with a slide rule.
So
very smooth, Alicia.
We think you're in a structurally different market. Productivity, 4.9% last quarter. We're in a world where there's productivity everywhere. It's showing up in corporate America, it's showing up in the data. Of course, you're not going to get 2% returns for over the next 10 years.
She had a pencil. She had a Dixon tie kind of She's throwing it at me right now. Ouch. She knows I'm setting her up because she knows I agree with her, even though I'm not allowed to say that on air. Alicia Levine, don't be a stranger. Can't say enough about her work at BNY Wealth. She's head of investment. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us on short notice now, Henrietta Treyz with Veda Partners, her interpretation of the Beltway. Henrietta, I'm not going to mince words in that Glenn Thrush and Colby Smith have it in the New York Times this morning. Bloomberg has it as well. The fact is the Trump administration and Mr. Pulte, in whatever form, love to go after people. Okay, fine. And then it gets to court, and the courts go, it's a Gilda Radner process. Never mind. And so you've got James, Letitia James, and Comey, and the rest of them. We're going to go after them. We're going to get them lots of, blather, if you will. And then the judges just go, no. Do you assume that's what's going to happen with the criminal Jerome Powell?
I think that's what will happen with Jerome Powell and also with Lisa Cook. That's sort of the chatter around financial regulator circles, my friends in the general Federal Reserve space, and monitoring exactly who those people are on the Fed board across the country and in DC. And one of the bases for this is that the courts are judging the Fed to continue to have a special relationship with the executive branch. And the expectation, the hope, certainly on Wall Street, is that that's going to hold into January 21st when Lisa Cook has her hearing. So we'll probably hear about the next nominee for Jay Powell going into that event. That's my base case.
Oh, thank you so much for joining us this morning with Henrietta Treyz, Alexis Christophers.
Getting lost in the sauce, Henrietta, is we could be looking at another government shutdown at the end of this month. How possible do you think that might be? And boy, oh boy, what does that do to an already messy start to 2026?
Yeah. 2026 is a hot mess. I love to look at the calendar. It's very instructive. And if you're an investor, follow the legislative schedule. It gives you a lot of data sets that you would otherwise, have to parse votes and things like that for. But just look at what we're going to do in the Senate this week. We got to debate the War Powers Resolution literally all week. The president lost 5 Republicans last week, and as a result, we're going to be on the floor doing that the entire time. Then the Senate goes on recess, and boom, we're at January 30th and a government shutdown. Meanwhile, you have contentions rising over ICE, the president requesting a 50% increase to the Defense Department, threatening Greenland. There are actions across the board, and losing Tom Tillis, who, by the way, did not vote against the War Powers Resolution, but like some of the other members, is a real problem for the president. It risks jamming up not just the federal nominations process, but the entire legislative agenda that Trump has. So going into the prospects of a shutdown January 30th is it's a 25% odd scenario and rising. And that's high for me. Usually I'm at 5%. I don't believe them when they say they're going to shut it down. But this time there's a lot on the table, and it's an election year. So there's a lot of reasons to be wary of that.
25% is a big number. And in terms of the Fed and what the Fed's going to do. We know we're going to get new leadership come May, but where are your odds for interest rate cuts this year, and how many? Because we know that J.P. Morgan recently shifted their stance. Right now, they're calling for no cuts this year.
Well, look at what's about to happen with the tariffs. The companies have squeezed all the margins they can out of productivity, out of labor. They've stopped hiring. They're not increasing wages. Now you really have the continuation of tariffs. And by the way, there are tons still to come across pharmaceuticals, semiconductors, critical minerals. Right. There are no deals reached with the EU, with India, with Japan, South Korea. There's a lot of work still to do. And so to have the tariffs continue to eat away at the number one thing that voters are concerned about is the biggest headwind. And so for inflation, Trump is plainly threatening Powell, which serves him, but it's because of the risk of not cutting interest rates because of the tariffs.
Hey, Henrietta, I gotta be quick here. You're just so happy this morning. It's just so much joyous news from Henrietta Treyz. Henrietta, the job gloom over the weekend. Job formation in 2025. Jobs formation since the Rose Garden moment in April. It's terrible. How is that treated in Washington? How do our elected officials look at those tweets of non-job formation?
It's just so strikingly obvious. You can see it every single data set you look at, from jobs to the approval rating of the president to Republican prospects in the midterm elections. Every single chart goes straight down, and it starts on Liberation Day.
Like
There's
bingo.
one thing and one thing only, and it's the tariffs.
Well, but quickly here. Then what's the reaction of the White House? The president's, whatever anybody thinks about him, he's a very astute politician.
I'm just going to say what my thesis is. I don't think the president can put tariffs on if the Supreme Court takes them off. I am out of consensus. I know it's controversial, but we're looking at Liberation Day 2.0 if the Supreme Court strikes down IEEPA. The confusion of migrating to Section 122, Section 338, it's not a plausible midterm election cycle inflation narrative for the president to pursue. So I think if the Supreme Court strikes these tariffs down, he's got to come off.
We got to get you back in later this week for more extended comments on post-Supreme Court. Henrietta Treyz with Veda Partners. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
No one supports newspapers because it's just breathlessly brilliant. Lisa Mateo with the newspapers on a Monday.
I got to live up to that. Okay, here we go. This one is in the Wall Street Journal. It's an interesting one. It's talking about job seekers, how they're finding this new source of income. They are basically being hired to train AI to take their job someday. Okay, so the Wall Street Journal is saying it's like the next gig economy. There's a company called Macquarie. It's an AI startup. It's hiring contractors to train AI to do different jobs, but it's not just everyday people. They're looking for
we heard this
astronomers.
Like 8 times.
Yeah, they're looking for these smart folks, psychologists, dermatologists, industrial engineers. They want poets, writers.
To do what?
To train these models to say the right things, basically, if you break it down.
So is it like
that.
If you can't beat them, join them kind of situation?
I guess you can. Yes, exactly. I guess you can say they're getting paid about $250 an hour, some of them. They get a referral bonus if they refer someone else, to do it. But it's kind of like this new thing that's being set up. I don't know.
It feels icky. I don't know.
Yes, it does a little bit. Yes, because it's taken their job away,
I must admit, there's a lot of different opinions out there on this. I don't have a strong opinion. What I know is the AI I use often is glaringly wrong.
Okay.
Like there'll be a single sentence where I'm like, I don't think that's accurate.
So hence that's why they're hiring these professionals
They're improving everything.
Yeah, this is exactly
healthy skepticism when you use AI. That's smart. Yeah.
That was very nerd newspapers. Do you have something more accessible?
I do. Okay, GLP-1s have a new celebrity face behind them. Are you ready for it? It is Tom Brady. Okay. What? Now, he hasn't said he's used GLP-1s. I just want to put it out there. He's basically the new chief wellness officer for eMed. It's a company. It's a digital health startup. It basically helps companies kind of manage the high cost of covering weight loss drugs for their employees.
Okay.
So he didn't say if he used it, but he did say he wants to be part of something that helps people, because he say this company is helping people. It's making it more affordable. He's served on the board of directors too. But 43%
I'd like to know
of
what he's
companies.
getting paid.
For
That's
a
what I
fee,
want to know.
exactly.
For a fee, yeah.
For a fee. We go to surveillance wellness correspondent John Tucker.
Yeah, I did real well over the weekend. I can tell you that one.
Okay, thank you for that, John Tucker, our surveillance wellness correspondent. Lisa,
That's a
save
new
us.
title. Okay. This one. Okay. Tom, I know you always talk about LinkedIn, but this article from Business Insider says that your ex could be stalking you on LinkedIn. Okay. It's known
Which one?
for.
Which one says John Tucker?
It's different. Like, you hear about these things on Facebook or Instagram, but you don't hear about it happening on LinkedIn. But apparently it's happening because at the unpaid level, if you have the unpaid level.
Well, that's key,
Yes.
Lisa.
This is the difference, okay? At the unpaid level, you have people who can look at the profile, but only if they allow others to see, when they've done the same. So you have to be an equal thing. But if you pay for the extra service, you can be kind of incognito, and you can kind of stroll and check out whoever's paid you want.
On that note, folks, I can't say enough about YouTube Premium. You have to pay for it. I asked Reto, keeper of the Amex, if he'd pick it up. He said no. I pay for it, and the answer is it's like LinkedIn Pay. It's like a whole different experience.
You get more features. Yeah, you get a lot more features.
Well, that was sort of a problematic newspapers today, wasn't it?
A little bit.
It makes you a little crazy.
Lisa Mateo, thank you so much. It is the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.